year was about to wrap up and be over. You thought we saw all the crazy shit, right? Well, I'm here to tell you, 12:52 my time, we just had 3 filings drop out of the 3 big subsidiaries of the DTCC, which is the NSCC, the National Securities Clearing Corporation, the Fixed Income Clearing Corporation, and the Depository Trust Company, and they all have the title of Enhanced Capital Requirements and Make Other Changes. I'm going to repeat that. Enhanced Capital Requirements. DTCC's filing is 165 pages long. FICC's filing is 240 pages long. NSCC's filing is 1,293 pages long, and 1,179 of those pages are redacted due to confidential information. Now, upon looking into this, I'm not going to go into it too much right now because it's late or early, or whatever you want to call it. This was filed 12/13. It references meetings that were held all the way back in November, so they've been working on this quite some time. But the gist of this one, if you remember the SFT service, if you remember what that's designed to do, it's the Securities Financing Transactions Service. So what that's designed to do is, I don't know if you remember, but there's 2 critical components of that SFT service. One of them is fire sale. The other one is liquidity drain. Now when it comes to fire sale, when a lot of members in NSCC or DTC, if a lot of them start liquidating assets simultaneously, that's called a fire sale. It affects the broader market, and the SFT is designed to mitigate that risk. It's going to mitigate that risk because the SFT service works as 2 going in, 1 coming out, cuts the problem in half. It's going to help sustain the impact of these market stress conditions they've been referring to all year. Now, this is the filing here that gives us insight to what those conditions are going to be, because what they're proposing to do is they're forcing to eliminate small and medium-sized members completely from the NSCC by forcing them into a situation where they're going to have to be required to sell their assets to pay for the excess net capital requirements that are becoming enhanced. And they're not just being enhanced a little. They're being enhanced by 20 times. So I'm going to leave you with a couple of comments or email comment responses from smaller banks and firms that just got wind of this proposal, and let you see what they think about it. And it kind of gives a good summary too for now, but I'll go into more detail tomorrow. And I still haven't looked at the DTC FICC, but I'm assuming it's very similar. But let's take a look. Samuel F. Leck blocks out who he's with or where he's from, so we're just going to read it. Okay, subject DTCC's proposed capital increase. Below is DTCC's latest proposal. They're proposing to increase the minimum capital requirement 10-fold. It clearly targets DTCC's smallest participants and makes no economic sense. The proposal discriminates against smaller broker-dealers, creates unwarranted barriers to entry, and is anti-competitive and is therefore at odds with the goals of the Securities and Exchange Act. This proposal makes no sense. Why would a firm that has a margin requirement, or otherwise known as a VAR tier, of $500,000 need $10 million in excess net capital? DTCC's margin is supposed to account for the risk. So why does a firm that, according to DTCC, could lose $500,000 need $10 million in excess net capital? The proposal makes no sense, or even less sense, when one considers that a firm with $1 billion VAR would also have only a $10 million minimum capital requirement. The proposed VAR tiers are extremely low and designed to target DTCC's smallest participants. It ignores the mega-sized participants that pose real risk for DTCC and instead discriminates against smaller firms that over the years have not shown to create much exposure for DTCC. It is simply ridiculous that a firm, $500,000 at risk, needs $10 million, which is 20 times the amount of risk, when a big player, or a firm with $1 billion, only needs $10 million, which is just 1%. So on the small side, you need 2,000% of the amount at risk, when a big player only needs 1% the amount of risk. That is effed up. So if you think retail's the only party here being taking advantage of this year? It's no. It's all these big players that you see in every security nowadays. So if DTCC felt that it needed to raise the capital requirements, it would target the large firms that actually create exposure. This proposal is a thinly veiled attempt to eliminate DTCC's smallest participants. Eliminate. They are trying to execute. The slaughter is coming. This is particularly offensive, given that there will be no grandfathering for existing member firms. They're given the finger and kicked out the door. This proposal is similar to DTCC's proposal in 2013 that was successfully defeated. They've tried this before in 2013. Wait, hold on a minute. Just gonna check something real quick. Let's see here. No, what am I doing? Let's go here. Reverse repo chart. Duh. Because I remember it looks like a dinosaur. There's a hump at some point. When was that hump? If it was 2013, I'm gonna shit my pants. Oh fudge. Oh god. Okay, so hear me out. Hear me out. They tried this in 2013. They failed. Repo demand kind of starts going up for the first time ever in that regard. All of a sudden, we hit, 2018, everything starts to go back down. So you're telling me at the same time they're trying this again, the repo starts going up again. Whatever stopped it back then has not worked this time. This is the crux of the problem. Is this right here? It's clear as day. So you're telling me that, and sorry, this is gonna be a lot longer video than I thought now, because you're telling me that how many of these did I open? Jesus, I'm autistic. Which one is it? God, man, there it is. 2013. When was it in 2013? Capital enhance. Is this today's? Yeah, god dang it. That's why you go here. You go tools, anytime, custom range from 01. Wait, what's the format? 01/01 2013 to 12/31 2013, and then you hit go. Now you refine it. What? Did it give the proposal name? I don't know. I don't want to waste any more time with that. But maybe we'll get another one here down here. But yeah, you see that this is going to cause huge problems. Huge. They're trying to eliminate small players. They're trying to further the monopoly, and then you have the majority of this filing redacted, of course, because it's likely due to the SFT servers team. We know they've been testing it all year. So it's just nuts. It's just nuts. And then we have this last one right here. Basically it says, ladies and gentlemen, this firm has been a member of DTCC or NSCC for more than 30 years. We have recently learned of the proposal to alter membership requirements by means of broadly increasing required excess net capital. Also, the current proposal is far less rigorous than it was its predecessor. Okay, so from a 2013 white paper. When was it? We suspect it suffers at least one important deficiency of that effort. That similarity, discrimination against mid-sized and smaller member firms, and in favor of the industry's largest participants. So, and then it goes on to say, DTCC and NSCC are regulated monopolies in a consolidating industry. Under no circumstances should they erect barriers to entry or cause further consolidation through excessive capital or regulatory requirements that are not based on risk. The overarching danger posed by SIFIs and SIFMUs are obviously well known to the authors of this proposal, but their importance is shrouded by a maximum ECN requirement of only 10 times that of the smallest member firms. Each of the top members are burdened too little, or the smallest are burdened too much. Please rethink this proposal. Jeez Louise, man. If you thought this was over, yeah, buckle up. This shit's not done yet. 2022 is going to be insane. That's nuts, though. I'm going to figure out when this was. I'll get into more detail on this tomorrow. But, look, it's all coming together, everybody.